So everyone asks about cost segregations, how they are helpful and when you should be doing it. This video I'm trying to explain how can you use cost segregation depending on your life situation to benefit and virtually pay zero taxes if you meet the requirements. Okay, these are complicated. This video is not going to be as comprehensive as you talking to your tax advisor, so make sure you go talk to your tax advisor. First of all, on our tax planning, okay, I know there are a lot of numbers. Do not worry about all of these. All I want you to understand is, for example, if you have a taxable income of, let's say, $369,000 after all the deductions, you will end up paying, if you look at my screen, around $132,000 in taxes, state and federal. And when I say state and federal, for this client, we're talking, this is a fake client. We're talking about they live in Georgia and make $500,000 income, has some deductions, and then it comes down to be $300 something, okay? Don't worry about those numbers. Just focus on this is a taxable income. How much of these can you offset and how much can you save is what we're talking about. So you have $369,000 of taxable income. You're going to pay around $132,000 in taxes, let's say, rough estimated amount. If you have 100% bonus depreciation, which is going to be probably for for until 2026, and then you have cost segregation is around 25%, and we'll talk about cost segregation next, what it is and when it's helpful. Your threshold on real estate is 1.4 million. Okay, let's say 1.5. So if you were to buy 1.5 million worth of real estate, you can completely wipe out a federal tax, which is $100,000. You can wipe out some of the state taxes if you live in states that do not allow bonus depreciation. So you're saving $114,000 out of $132,000 in taxes. That's a huge tax savings. Now let's say if I reduce this, let's say you don't have to buy $1.5 million. Let's say you only buy $500,000 of real estate, right? That's a $41,000 tax savings, still a significant amount of tax savings. So how to get there is what I'm trying to explain, okay? You understand the concept now. So let's say you already have a long-term rental, or you're going to buy a long-term rental, you're going to buy a short-term rental or apartment. How does that work? Let's talk about that. That's what I'm going to focus on. So very basic understanding of how this works is you have W-2 income, you have 1099 income, you're a consultant, or you have other real estate activities, you're an agent, or you're construction or wholesaling, doesn't really matter, okay? You have a lot of other income, non-passive income, and you have a passive income from real estate, because real estate are always passive, rental real estate, okay? So how can you use the losses from real estate through cost segregation? Okay, remember, when I say losses, we're not talking about you going and buying real estate and losing money. That would be not a business strategy, right? You have to make money. But depreciation is phantom loss. It's a fake loss, right? A paper loss, and it helps you offset your actual income, so you save a lot of taxes. I'm not going to go into that concept because I hope you already understand that. Goal is this. Let's say you make $400,000 of income. You have interest and capital dividend income of another $100,000. If you can harness a real estate loss of around $350,000, then your taxable income from almost from 550 goes to $200,000. That's a huge tax savings. So the goal is what? The goal is to harness real estate losses, convert those losses into non-passive loss. Remember, passive loss and non-passive income cannot offset each other. That's why the rep status and loophole comes into play. That's what we have been talking about in other videos, right? But the goal is to harness real estate losses, convert passive losses to non-passive loss, and offset each other to save taxes. That's the concept, high-level concept. And you can pause this and watch this. So I hope everyone understands what cost segregation is. I'm going to give a very high level understanding of that. Let's say you buy $1 million property. Just focus on this. Don't focus on this. You buy $1 million property and you depreciate over 39 years. Normal commercial property, right? Every year you get around $23,000 depreciation. That's a phantom loss I was talking about. If you have $23,000 net income after all the expenses after renting out a property, you still have to pay zero taxes if your depreciation is $23,000, which it is. So you're paying no taxes on your real estate income. That's why people like to invest in real estate. But we are going even further. We are actually trying to increase this $23,000 to $200,000 through cost segregation. What cost segregation does is it segregates your assets into different classes of property. So if you buy this $1 million property, you see you'll have segregated the cost into $50,000, $60,000, various classes of asset which can be written off right away with bonus depreciation. That's the law. Okay, that's why all the wealthy people came up with the law to save taxes. All the lawmakers, doesn't matter which party you are. Okay, that's what they do. Now you increased your losses from depreciation loss from $23,000 to $200,000. So if you're in tax bracket of 36%, you're saving $73,000 on taxes, okay? Again, rough numbers here. Hopefully I will give you a very high level recap of why cost segregation, why we need that, and what's the goal. Goal is to take the losses from real estate through that depreciation, $200,000, to offset your W2 income or the income. But how can you do that is what I'm going to talk about next. People ask, so before I go into that, people ask this question. They always say, if we take this huge depreciation the first year, what happens to other years? They always ask that. Let me give you a quick math here. Let's say you do not do bonus depreciation, cost segregation, or $1 million property. We are assuming there's no land here, okay? $1 million property at 39 years, you're getting a depreciation of $23,000 every single year. But let's say you take that $210 of extra depreciation the first year, then you still have almost $800,000 of basis for the remaining 39 years. So every other year you still take $17,000 of depreciation, meaning the difference in depreciation every year is around $5,000. Again, this is not a tax savings, it's just a deduction. Then you have to use this and multiply your tax rate. So maybe every year you're saving around $1,500, but you already saved $73,000 the first year. So it's just a timing difference. You're just front loading all the tax savings so you can go invest $73,000 in another real estate and repeat this, right? Again, not going into investment strategies here. I'm just saying, if you do not take bonus depreciation, the difference is you still get to deduct a lot of expenses in the other years, but you also have, you're only off by $5,000 every year on the $1 million property. Again, quick math, because people ask that a lot. So with all that understanding, what we're trying to answer today is, okay, when should you be doing cost segregation? Do you have a long-term rental you already own, or short-term rental you already own? New properties, that's what we're going to talk about. When is this helpful and when you should think about doing cost segregation? So first thing is this, okay. So everyone understands cost segregation, the benefit, it looks great. The question is, okay, the benefit looks great. How do we use the losses? Here you go. There are 3 ways to use losses from cost segregation. The first way is, if you make less than $150,000 of Maggie adjusted gross income, let's say your adjusted gross income is less than 150, to some extent you can use cost segregation. You don't have to be in full-time real estate. There's no short-term rental required. You can use some of the losses. The maximum is $25,000. You could use $25,000 loss from your real estate. If you're single and you make less than 150, or you're married, you make less than 150, remember, you buy real estate, you can offset up to $25,000 of your any kind of income. It's that simple. But let's say you make more than that. What are 2 other ways? Second way is you need to qualify as real estate professional. That's, it's not a licensing requirement. It's an hour requirement. How much hour you're spending in real estate. There's a whole other video discussing all those, so I'm not going to go over that. If you qualify as real estate professional, then you can use the losses that we just harnessed to depreciation to offset your W2 income. If both of these do not apply to you, you're not making less than 150, or you're not on rep status, then you would look at short-term rental loophole. It's another video on short-term rental loophole, so I'm not going to go over that again. It's going to be too long. Now, with that in mind, when is cost segregation helpful? Can you just do cost segregation? Let's talk about this. If one spouse qualifies full-time real estate, meaning you meet the real estate professional status, when does the cost segregation is helpful? If you have a short-term rental, you have to materially participate in short-term rental, then you can benefit. Anyone can benefit from short-term rental. If you look here, okay, short-term rental applies to everyone. That's the short-term rental loophole. If you materially participate in short-term rental, everyone can use that. So when is cost segregation helpful? On a short-term rental, it's always helpful. Long-term rental, you need to be reps, real estate professional status, and materially participate on the long-term rental. So if one spouse is full-time real estate and the other spouses have W2 income or a business, then you qualify as real estate professional. Then cost segregation is helpful on both long-term rental and short-term rental. Short-term rental, you have to materially participate. Long-term rental, you have to be reps, that's why you're full-time real estate, and you have to materially participate on the long-term rental. You understand that? If both spouses have W2 income, you will not if you cannot qualify as reps, which you probably will not, then you look at a short-term rental and you materially participate in the short-term rental. If you're a business owner and you do not qualify as reps because one of your spouses is not a full-time real estate, your spouse is a homemaker and you are the full-time business owner, then and you do not qualify as reps, then you do need to have a short-term rental in your portfolio to offset your income the way we showed you earlier. Okay, so that's when the cost seg is helpful. You need to understand you need to be you need to buy short-term rental, long-term rental, you need to be reps, right? So The last question is, people ask, okay, is cost seg even helpful if you're not a real estate professional in long-term rental and short-term rental both? So let's talk about that. Same concept, one spouse, both spouses W2 and business owners, right? Short-term rental, like I said, there's no need for rep status, right? You need to just materially participate in short-term rental. If you do not qualify as reps, if you qualify as reps or you're business owners, doesn't really matter. Short-term rental, you always need to materially participate on the short-term rental. There's no need for reps. You always can do cost segregation on your properties. If you have short-term rental you bought in the previous years, you can still benefit if you do cost segregation. Okay, you have to file a form called 3115 to reclaim the depreciations, but you can also still benefit. That's the first thing. Biggest question is the long-term rental. Should you be doing cost segregation on the long-term rentals? All these different three scenarios. If you have an old long-term rental, should you be doing it? The answer is complicated because everything we just talked about needs to be understood, right? Long-term rental, you can only benefit if you qualify as reps and if you materially participate. For other two, so you would always, so is it helpful even if you don't qualify as reps? This is reps. You're always going to do cost segregation because you qualify as reps. Long-term rental, we understand that. But if you are not a rep, again, you're not a real estate professional, and you both spouse has a W2 income or you're a business owner, and so is a long-term rental helpful is the biggest question. Let me tell you the answer. Without a short-term rental or other passive income, cost seg on a long-term rental is not helpful for these two professions without rep status. So why is this? Let me explain. Short-term rentals are unlike long-term rentals. They actually make money. In your portfolio, if you expect to buy more properties in a short-term rental asset, you could potentially benefit from cost segregation on long-term rentals. You do a cost segregation on long-term rentals, your short-term rentals after a few years starts making money, and you can use the cost seg losses from long-term rental to offset the short-term rental income in the future. Or if you have other passive income, let's say you own a restaurant as a passive investor, you have a bunch of other K1 investment in syndications that's giving you a lot of passive income, or they are selling the asset and you're getting passive capital gains that year. You can use a loss from cost seg on long-term rentals, which was not helpful before, to offset them. So if you're going to buy a long-term rental, you should really think about, should I be doing cost segregation even though I do not qualify as a real estate professional? That needs to happen. Again, this is complicated. That's why you got to work with a tax advisor who understands this and incorporate that in your tax planning. And that's exactly what we do, right? What I was showing you earlier is we, again, do not get hung up on all of these 80 tabs we have for tax planning, but we go through the 1031st exchange. How's the 1031st exchange and gain calculation? Should you be doing cost segregation and S corporations and entity structuring? All of those are important for you to get the benefit. What I'm saying is very high level. You can pay zero taxes, but it's complicated. So talk to your tax advisor and make the decision. Slow this down, listen to this again, and you'll understand this. There are multiple other videos as well. Watch them, and you need to understand other concepts to understand this as well. So we'll send more videos out. Subscribe and you'll learn a lot. Thank you.